skin in the game. The problem here is that, as I was saying, you are not going to take risk. Is it positive? I'm a very good friend as well, and then I can invest in these projects. Some of them are very safe, some of them are very risky. If the safe ones offer me a minimum return, I'm not going to take this risk. So collateral seems like very good for good firms, but on the other hand, it's going to be negative for in terms of risk taking. You know? So this is what it's saying here. So it ensures good behavior, that's fine, but I'm going to show you this paper that it has some consequences. Right? And this is the first paper that I work here is with Antonio as well, in which we found in the paper that requiring personal guarantees could be good in terms of the moral hazard, blah, 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 but the firms that use these guarantees don't take risk. Because I mean, I'm the manager, I'm the owner of the firm, look, I'm betting in some sense on using not my present wealth, also the future one, the one of my family, the one of my children. So, and it's not good for them. So everything was very nice up to here, but in this paper, I will show you that this is not the case. Okay, so this is a paper that we did with confidential data from a Spanish bank. And the nice thing is that it was I cannot tell you the name of the bank, but it was very nice because it was a bank that was in a bad situation at that moment, and they started to require to their clients a lot of personal guarantees. So instead of using collateral, they found that with personal guarantees I can charge a much higher coverage ratio. You know what the coverage ratio is, no? Is the size of the collateral relative to the size of the loan. And there were some cases in which the coverage ratio was 200%. So if I default, I'm going to pay no 100 but 200. So for the bank. And on top of that, they were using something that is called Politras, I don't know the English name. In Spain is Politras de financiamiento the paper we have the Spanish name. So the issue with this is that you use these contracts, these clauses in the loan, and all the money you have goes directly to the bank. I mean, what you were saying about the bankruptcy law, forget about it. So all the money that you have in the bank goes directly to them. Everything you have goes directly to them. You don't need to go to the judge, you don't need to go anywhere. And you have this plus a coverage ratio of 200%, you will see what happens with the banks. Okay? With the bank. So the guarantees that we consider here, two types in the literature. The collateral is the one that I was saying related to your customer, and these are assets. So in Spain, this is what we observe, mainly real estate, financial, or movable assets. Okay, so it's not that we have these cash flows. Here is assets that can be in some sense measured.
That's in Spain or is it Europe? In the States,
Spain and Europe. It's very similar, the use of collateral. So Spain is not an exception, right? But two types of collateral. This one, in some sense, if the firm defaults, the lender cancels the collateral. So I get the house and I cancel the house, right? And the second one are the personal guarantees, right? And this is, as I was saying there, direct and joint liability of the new guarantors whose solvency is sufficiently demonstrated. So it's not that a bank accepts a personal guarantee from someone that is in default. I mean, you need to show the bank that your quality is good in order to offer a personal guarantee, right? And there are two types of personal guarantees. One are the ones associated to specific persons, so managers or third person to the firm, and the other are the public ones, the one associated to institutions. So I was referring to the Spanish public bank, the ICO, the government, directly to other institutions. So these are the three types of guarantees. And as I was saying here, the important part of these guarantees is that it's based on the parties' present and future wealth. So when a government offers a guarantee, it's not based on the situation right now. It's based on the future situation. So it's not that a government can offer a guarantee of 10 years. They are going to consider the situation now, and they are going to consider forecast the ability of the bank to pay later.
To calculate all of these, they have like formulas. They have like formulas, like of probability and everything.
For this, yeah. I mean, it's not easy in the sense that, I mean, this is very important because what you are saying, in order to obtain the probability of default of the, let's say, or the money that I obtain from the collateral, for instance, for the case of real assets, they are going to consider what? The evolution or the forecast of housing prices in, let's say, in the region in which the collateral is, right? So if you offer me as collateral, you remember the airport in Ciudad Real, no? That was the empty. If you offer me this as a collateral, probably, the value could be this one, but I am going to discount what is going to happen with this in the future. So if this airport is not working, I'm not going to, So the same, so it's not the same, a house in a place in which the housing market is booming or a house in a rural area in a state, right? So you consider the present and the future value of the asset. And with the guarantees here as well. That's why it affects to the risk weights, you learn, no? With Herman, the risk weights. The risk weights of the loan are determined based on this. So if I have a guarantee from the government that covers 100% of the loan, what is the risk weight? 0. Right? So if the guarantee, same size, but you are the guarantor, the risk weight is going to be higher, right? So in order to define the risk weights, depends also on the correlation between the firm that obtains the correlation of the profits, of the firm that obtains the credit and the value of the collateral. So if I'm the owner of the company and I'm offering as a collateral something that is closely connected to the activity of the firm, the risk weights are not going to be so low, right?
Using real estate as collateral, does it matter if it's paid off?
Second?
If when you're using like real estate as collateral,
Yeah.
does it matter like the real estate it's being financed or that's something paid off?
Yeah. Of course, it's not the same. In fact, I don't know if you can offer as a collateral something, because in that case, you are suppose that it's a mortgage, no? It's a good question. It's a mortgage and the loan to value is 100%. The bank is not going to accept as a collateral something that belongs to the bank itself, no? Because the bank would look, you are offering the house, but
then I lose it.
But you can, I don't know, you pay off half, you have equity on the mortgage, you can take the equity out, right?
And then we sell the house or you give the
yeah,
But you give the.
but the point is if the house has a mortgage behind.
But even if let's say a mortgage is 200,000 and you pay 150,000.
No, of course there is a net, but suppose I was saying that the case in which the loan to value is 100%.
Oh, okay.
So
So the more you pay, the more equity you get.
Exactly. So suppose I'm the bank and you tell me, look, I'm going to use this house.
No, and it's already their house.
Exactly. So it depends in some sense on the remaining loan to value. So you can use the part of the loan to value that is yours, right? Not the one that belongs to the bank because they gave you a mortgage.
It's with the same bank, it's easier than if you have the mortgage with another bank.
The banks can check it very easily because for households, for instance, they have information to that, they have access to the credit registry and they can see the debts associated to that
So
asset.
it's the same.
Exactly. So it doesn't matter who is the bank. They know that you are offering me an asset. You go, for instance, to the information that the notarios, notarios in Spain, they have information on every single house, and you can see whether the house has a mortgage associated to it.
So there was this case which is like a little funny. That happened in my city. These people who were like criminals. It's called in Despojo, and what did it? Actually, it's people that I know that I met. I'm not related to them, but so what they will do? It was like 3 people. So it was this very rich lady who bank accounts in the United States, but she lived in Mexico. So she had like very good credits in those banks like Sabadell or Santander and Miami. So what they did is she took out a loan to buy a house or like a very luxurious like apartment in Cancun, and then she was in a fake company with two of her like partners, like business partners. So what they did, for 3 years they were paying, like the mortgages, like payments, and after 3 years, they did like fake like pay stubs or something like that in that fake company. So they did like the 2 other partners sued the owner of the apartment. So she lost it like in a lawsuit, So when they stopped like paying for the mortgage, Saturday tries to see what happened, and like she lost the asset. So she was she took a loan, bought a a very fancy apartment, and then after 3 years she paid it, and then she won default, but like she lost the asset. So when the so the way we did that like over and over. So
But this is because probably, I mean, the issue was with the bank, no? Probably they should have,
yeah, so they like the bank from the United States issued a loan to buy like a real estate asset like in Mexico.
exactly. I mean, this is an issue. I don't think that, I mean, now in Europe, I think that this is different, no? But I mean, it's true that, in the past, I mean, being in different countries, I think that affects a lot, no? Because, I mean, this is like two banks. I mean, this is the example of, that is a very good example. No? Two banks that don't have access to the same.
Yeah.
But even, I mean, think in Spain, no? In Spain, you know that the most important type of financing for firms, I would say, or one or the second, is trade credit. So trade credit means that I sell you something and you don't pay now, and you pay me later. No? You delay the payment, right? And I mean, there, in some sense, I'm lending you money, right? So you get an asset and you are going to pay it later. So this is a loan. So suppose that you are a bank, or I'm a bank, sorry, and I do the same loan with the same maturity, whatever. I can see the credit registry whether you are a good client or not. But in that case of trade credit, I cannot see any. So that's why, in some sense, you see that firms start paying first to the bank and second to the clients to which they don't have information, right? So here, in some sense, it's the same. So they didn't have access to information and they cannot take good decisions. And the same is with the trade credit. So that's why information is so important.
And like I don't think like the bank in the United States too, like they probably have like some kind of like or something like like a credit spread swap, like a credit a CDS spread, where they like do if like the loan gets defaulted, it gets like paid by someone else.
But you know the problem with the CDSs is that the CDSs are very standard, and in many cases the notional is 10 million euros or dollars or whatever. So if the exposure is small, then you need to use a CDS for covering not this exposure, many of them. So if it's a product that is over the counter and is especially designed for this, like an insurance, then the spread that they have to pay for this insurance probably is very high. Right? So that's the problem with the derivatives. I mean, the derivatives are very standardized. The cost is that, of course, they are very standardized and it's easy to close and open positions in a derivative. The disadvantage is that when you try to do something special for a company that is out of the, let's say, the system, it's very difficult to do so. So, I mean, it's not difficult, it's costly. Right? The movie, have you seen I don't know, this movie about there is a movie about the financial crisis. I mentioned this one in the last class. There, you remember that they designed a CDS for the client, and it was so expensive because it was especially designed for that the banks were saying, I mean, you are not going to pay this. He has information and he said, yes, I want to pay this because I have this information and I know that they are going to default. But when there is something so customized, the cost is very large, and the amount of money that you have to pay is very large. So I don't think, but yeah, the information matters, of course. So what I want to say here is that most of the papers up to the moment in which we wrote this paper were using, in some sense, the loan rates, depending on whether the loan has collateral or not, what we were saying before. So I use collateral, the loan rate is lower, fine, or the determinants of using collateral. That is why firms use collateral or not. But this was the first paper that studies the two types of collateral and how it affects to asymmetric information and how it affects to the firm decision. And here you can see the example of the bank. I mean, this is a real example. Here you can see the portfolio of the bank in terms of the number of loans and in terms also on the amount outstanding. And we split the loans here in three categories. You see, for instance, in 2006, you were saying before, no? You were referring to the crisis, 2008. Look at 2006. Most of the loans, 90%, no guarantee. No? You go to this example. No? I mean, when you see the size, of course, I mean, the larger loans in some cases, they require guarantees. But as you can see, as time passes, what happens in black, the financial crisis, the sovereign debt crisis, you see 2011, and look at 2012, the first semester. It jumps. Something happened there. So the banks are not stupid and they say, look, I need a guarantee in order to believe you, otherwise. And you can see here as well, no, that the amount of loans with collateral in terms of outstanding is increases. What happened there is that there was a stress test, a European stress test to the banks, and they found that some banks failed the stress test. And what they did is to require more buffers, because banks were very exposed to sovereign debt. No? And at that moment, you remember that people were saying that it was the end of the euro, blah, 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 and they say, look, I mean, we are very exposed to sovereign risk, we need to have more buffers, we need more capital in order to show the investors that if something happens to the governments, we have enough capital to deal with this. No? And there was something that you remember when they were talking about the end of the euro, there was an expression that probably you heard this a lot, this redenomination risk. Have you heard about it?
Oh, I was like 5 in that.
The risk is that all the currencies of the bonds that were issued has to be redenominated, right? In the sense that if the euro collapses, what is going to be the currency of this contract, for instance?
So there's an research that tells you what the sweet spot on collaterals, like anything related to what's a good equilibrium on how much collateral you should ask, when you should ask it, like something like the leverage ratio, right? It's well said that it has to be below 4. They will say that like that's like a benchmark. Especially with this sort of stuff. Like okay, there's a lot of research and this is the
We will see something related to that, no? In the sense that there is an equilibrium here. I will show you it later, and then we can talk more about this. But it comes something related to that, no? So the point here is that you can see the huge, here is the zoom in that moment. You can see the huge increase in the proportion of loans and the amount outstanding of loans with personal guarantees. So this bank said, we have a problem, I'm going to charge personal guarantees, and I'm going to have a coverage ratio of up to 200%. So if the loan defaults, the value is 100, they will get up to 200 because of this emotion. Right? With the collateral, with the collateral is almost 100. So related to this, no? What explains the increase in the requirements of collateral? So first of all, they wanted to mitigate credit risk. So there is a problem here. And the second thing is, if I need to increase my capital, if I need to increase my buffer, the easiest way to me is to reduce the risk-weighted assets. And I was referring before that the loans with collateral has lower risk weights. So it's perfect. So less risk, and at the same time you need more capital, and I'm going to show you that I can increase my capital. And I was saying that it was the recommendation after the stress test, and in October 11 they said, this has to be something that I remember it was like 1 year, you need to increase your collateral by your capital by 1 percentage point. So this is a shock, no? When we're talking in the first class about what you need in order to do a paper, this is a clear shock, and there are many other papers that came later using this shock in order to see what happens in terms of lending, no? I mean, this is a shock to the bank. If they need to increase collateral, what are they expecting with the lending? It decreases, right? So it was very quick enforcement. This is very important. When you have a shock, it's not something that in the next year or in the next 2 years, it's something that happens now and affects immediately. It's something that, in some sense, is unexpected, right? I mean, a shock has to be something that is unexpected, and the incentives that I was saying here are the same. So we use 500,000 loans with firm information. We know the relationship between the bank and the firm. And importantly, something that we did in the paper is to use firm characteristics, and in order to measure relationship lending, we were using the distance between the branch and the headquarters, no? Because it matters. Okay. So the first set of results. This is the proportion of loans with the 2 types of guarantees. No? In our sample, you see personal guarantees, 35% of the loans, collateral, 8%. But you can see the average coverage ratio. The coverage ratio is the ratio between the guarantee and the size of the loan. Personal guarantees, 160%. The maximum is 1,300, right? So if you lose 10, you have to pay me 130. It's good, eh?
That's the max. And the mean?
The mean is an outlier probably. I will show you later how to do it.
So wait, can you interpret that again? Like, so 1,300, that's the max, meaning like for every 100.
The 163 means that for every 100 euros that you are not able to pay me, I will require, with this guarantee, 160.
So here in ratio, they put in the denominator into the wealth of their customer.
No, they use the coverage. I mean, of course, it has to be paid with the wealth. Probably the wealth of the customer is larger, but it's related to the coverage that the borrower offers.
As your asset they give.
It's like the limit, right? It doesn't mean that your wealth is this. Your wealth could be more, but if the coverage ratio of the loan is 200, it means that you are offering me an insurance for up to 200.
So why is so huge?
Why is so huge? First, because it's more difficult, like, for instance, with the collateral, no? You see, I mean, this is an outlier, not the 400, but with collateral, the mean is 95%. So, because that is very easy, if you offer a deposit as a collateral or a house as a collateral, we value the house, and then I tell you, I give you the loan, but you need to cover this. With the other is the wealth, and then you have to see in the data of the borrower that they have enough wealth in order to pay that. But then you use the threshold because in some sense it's riskier, right? I mean, this is up to, and then it's more difficult to value, right? It's more difficult. And for the banks, you prefer to have in some sense a real asset rather than a promise of future payments. But the point here is that they have this póliza de financiamiento mercantil, so if they don't pay, they immediately should take the money.
So I understood the 163, and for every 100, you get 163, but the 1,300 is the max of what exactly?
Where is the
The 1,300.
this one?
Yeah.
No, this is the maximum. This is the maximum coverage ratio for loan. I mean, this is, I told you, this could be an outlier. That's why I will show you later, you know how to winsorize, no? The data. Have you used the winsorization? So when you have this data, I will show you the command. When you need to do these two, there are two possibilities. One is the trimming, and the other is the winsory. With the trimming, what you do, suppose that you have this huge data, no? I mean, everything is, let's say, between 75 and 100. And then you have 2 points here, very extreme, and then you say, look, I mean, this is the 1 percentile, the first percentile, sorry, and this is the 90th percentile. And then what you do is to remove all the observations that are here or here. Right? You remove it, you drop this. This is the dream. With the winsorization, you do something different. With the winsorization, what you do is, suppose that this is 75, what you do with the winsorization is, for all the numbers that are below this, all of them are going to be 75. And for all the numbers that are above this, all of them are going to be 100. So you winsorize in the sense that, right? So when you run regressions, the first thing that you have to see is which is the distribution of the data. So you have very extreme values, you run the regressions and you can get anything, probably things that don't make sense. Because your data are contaminated by the stream. So this is a good example. So when you do this 0.01, we did this to winsorize. We remove this observation, we don't use it because it doesn't make sense that you use a collateral for 1%. If it's very large, you also remove it, right? So in this case, this would be the example. With the trimming, you drop observations. With the winsor, you don't drop observations, but you are going to say that everything that is below 75 takes the value of 75, and everything that is above takes the value of 100. I will give you tomorrow or later the state commands, right, to do these tricks, because it's very important when you run regressions, otherwise you're going to get results that are very noisy.
Okay, I have 2 questions. The first one is, how to decide if trimming or wind scissoring in practice? And
I mean, this is optional, it's the same, the idea is the same. I mean, many people prefer the trimming because they remove the observations. with the winsorizing, you are assigning something that is close. I know that is fictitious, but I don't like to lose observations, so I always winsorize. But I mean, the two are okay. How do you decide? This is the distribution. You see what is the 99 percentile. So in some cases you need to use, for instance, let's say, instead of this one, you need to use the 95th percentile. For instance, when you use firm data, and you use, for instance, the ratio of liquid assets over total, suppose that the assets, liquid assets over total assets, suppose that the assets are not well reported, you could have ratios that are very extreme. The regressions that you are going to get are wrong. Then you need to windsorize and then you see the distribution. Extreme values are, if they don't make sense, you need to remove them.
And there's a question regarding the personal guarantee coverage. What's happening if, for example, I get a loan and I want 10 Bitcoins and 120K and I give the Bitcoins and the Bitcoin falls to 20K, does the bank call me, hey, you have to put on 200K to cover that, or?
The answer is I don't know. I mean, because I don't know how it works, honestly.
Or for example, if I have a house and you fire some.
But I mean, the point is that, of course, I mean, you can, I think, I mean, another way to answer the question. When you sign the contract today, it's not that you cannot use the wealth. You can use it. So that's why personal guarantees require a higher coverage, because I don't know how it's going to work. In some sense, the guarantee depends on the probability of being employed, the probability of, I don't know, don't be sick. That's why they are not going to tell you 100%, they are going to ask you more. This is one explanation. So of course, I mean, it's not, if you cannot pay, of course this is an issue, but with this qualified affiancamiento mercantil, they can withdraw directly the money that you have in your account. And they see it now. And if I offer you this contract, I am going to be the bank in which you have the deposits. And the bank in which you get the salary. The bank, you know.
But can a bank margin call you, like they say, hey, your house, we signed a contract for 1 million, it's worth $50,000 because you had a hurricane.
I mean, it's not that there is let's say, a margin calls in this type of guarantees, but it's true that when they design the guarantee, they consider the type of guarantee and the maturity of the loan in order to do that. So implicitly, there is a margin call. I mean, you are a risky client. I'm not going to offer you a loan with a guarantee of 10 years. No? I mean, it happens. I have friends that are like 50, whatever, they don't get a mortgage. Because the banks look, I mean, you are 52 and I'm going to give you a mortgage because you are being working until, I don't know, you are 70, what happens with the remaining time? Only if I can offer you a mortgage with a time to maturity, let's say 10 years, I offer you a loan, otherwise I don't. No? It's the same, I mean, they discount the value of the guarantee in the future. According to on the asset that you have.
They include that in the pricing.
Exactly. The pricing and in the loan to value that they need. Okay? So the first question is, what are the determinants of personal and real guarantees? No, this is the first question related to what you were saying before. So here, the dependent variable is the guarantee that could be real or personal. So the loan has a guarantee or the loan hasn't a guarantee, and the two types of guarantees. And then bank characteristics, loan characteristics, and the other set of characteristics. This is just to show that what the paper that we have seen before was saying is not true. So what were you expecting in terms of this? I cannot, but in terms of...
only for the existence of the personal guarantee, it's how does that only work? One if what?
One in this column is one if it has a personal guarantee. In this column, one if it has collateral. And zero the opposite. Look, if what you are saying is true regarding the risk of the guarantors, no? In the sense that I'm a safe guarantor, I'm a safe client, and I offer a guarantee. Look what happens with the variable refinancing. Refinancing is whether the loan has to be refinanced, in the sense that I cannot pay, and we need to extend the maturity, or we need to extend the amount of the loan because I cannot pay, no? And then the bank refinance the loan. It's positive, right? What happens with the leverage? It's also positive. So it means that banks use guarantees with riskier clients, right? So it's not that the same clients are the ones that offer the guarantees. The banks know that you are risky, and I'm going to say, look, if you want the loan, I need the guarantee. And that explains that the refinancing and the leverage has a positive coefficient. Okay? The personal guarantee, the total assets of the firm. When do I use personal guarantees? Can I use a personal guarantee for Telefonica? Can I say the CEO of Telefonica, look, I want a personal guarantee? It's impossible, no? So the larger the companies, the less frequent are the personal guarantees. No? Person means, something that is personal, right? So big corporations cannot use it. So the examples that we were saying before are very large corporations. So here it doesn't not make sense to consider this type of guarantee. Look, this is very important. The bank characteristic. This is the distance between the branch of the bank where the loan is granted and the headquarters. And what is the coefficient here? What does it mean?
The distance between the headquarters of the bank and the company, the probability of you using a personal guarantee or asking for a collateral.
But why?
Because they're riskier.
Not necessarily.
You don't know that person that well.
Exactly. And this is related to what we were saying before.
And you're soft.
Soft information matters, but the longer you are from me, the less I trust the soft information.
So what is the variable that says that again?
Here,
Oh, the branch headquarters.
is, for each loan, I know the branch where the loan is granted, and I take the distance between the branch and the headquarters. So I see where the headquarters of the bank are, in Madrid, or wherever, and I see the distance. And I take the logarithm in kilometers. So what it's telling you is, if they are very close, I trust you more, and you are very fast. So soft information matters, but in the end, this is what I was saying in the other paper that I was mentioning. The larger the distance, the larger are the interest rate that I'm charging, the more probable is that I ask for a guarantee, because it's not that I don't trust them. The information as the distance increases, the value of information decreases. Okay, and this is what the same. And in terms of loan characteristics, it depends on the loan maturity. The longer the maturity, the higher is the probability of default, no? If you ask for a loan with a maturity of 3 months, I see your balances today, I see the information today, and in 3 months it's not so likely that you don't pay me. But if you ask me for a loan in 10 years, 10 years there are a lot of risks, no, associated to the loan. And then I require not just a personal guarantee, but also a collateral. But look at this is very important. So the coefficient is larger for the collateral. Because what happens with the personal guarantees as time passes? For very, let's say, long maturities, the uncertainty is larger, no? I mean, you offer me as a guarantee a deposit of 10 million euros, this is a deposit, so it doesn't matter what happens. The deposit is there for 10 years, and I know that the money is going to be there. But if you offer me a guarantee related to your present and future wealth, in 10 years the risk is much higher. Okay? And then we use the standard.
For example, we can take that like the time premium of the loan, that coefficient.
No, because the dependent variable is not the interest rate. But if you do that using as the dependent variable the interest rate, you will see that the larger the maturity, the larger is the premium. This is the term premium, right? That you have started in macro.
I don't know if it's decided, but the loan to maturity, like 1 month, that's how much they like, what percentage to pay.
I mean,
I like this one.
because no, because this is in Spain, this is less than 1 year. Okay?
What language?
It's not complicated.
But this is a very good question, because we are talking about maturity and you are thinking about the term premium, blah blah blah. It's 1 year. 90% of the loans in Spain, more than 90%, have a maturity lower than 1 year. Okay? And then I have the question to you is, how can firms invest with that maturity?
Yeah, like when you use
Recently, that's the point.
I have 25-year loans, like for
Yeah.
big facility.
Yeah, 90, I don't remember. This is, we didn't mention it in class, but 90, I don't remember but more than 90% is less than 1 year. Right? And then, related to this question, it's about banking, but it's very important, the maturity of the loans. So just 2 minutes. when you see the ICO, they have now a new program that is called ICO Crecimiento, no? That is, this is the name. If you go to their webpage, you can see. And related to your question, they said it has been successful. So it's been amazing. You know the maturity of these loans? 10 years. I mean, I'm a firm, and you offer me the possibility, no, to obtain a loan with a similar price for 10 years, I invest with this. But if every year I need to go to your office to ask you for a new loan, I mean, this is very complicated.
So the whole because this is when mistakes very common, like debt restructuring, right? Like there's a point where you have so many banks and you provide so much work on the inside when you're in treasury. So you're like, okay, I go to the bank and be okay, I want to put all this debt into you, and then obviously they're interested because they want all the interest rates and stuff, but they provide a longer span, right? I've done that a couple times in the States, but it's here common because based on that, that's not that common, right? Because then the 1 year loan will become a 5 year loan. But but you buy out of this debt, right?
I mean, it's true that, I mean, we will see later that you have this hold up problem, no? We can do that.
No,
This is
right.
there is an equilibrium, and on the one hand, it's good to have several banks instead of just one, right?
But it also depends on the context, because you're not a risky firm, you're not tied up to that bank.
Yeah, but suppose that there is a crisis and
yeah.
one bank is affected by the crisis. So if the bank, it happens, for instance, in Spain in 2009, there were many firms working with the only savings bank. And with the crisis, there were some savings banks that have to be restructured, I mean, with public. If you are exposed to only one, it's true that probably you can get better conditions in terms of pricing, in terms of maturity, but at the same time, you are more exposed to the risk of the bank, because it's very difficult. The switching costs that I was saying are very, very large if the bank to which you are exposed defaults. So there is a paper by Diana Bonfin, Steven Ongena, that is called, you will remember the name, no? Sorry, we are closed. And it's about this, because how difficult it is for firms to change not just the bank, but the branches. Suppose that a branch of a given bank closes in an area, it's very difficult to start negotiating with another branch of the same bank. Right? So this is a process. But what I wanted to say is that this is very important because you understand how these are used. And the maturity is something more about economics, not just about this. It's very difficult that firms in a country invest if the loan to maturity, if the maturity of the loan is less than 1 year. Because there is a lot of uncertainty. And when the ECB approved, you remember the CSPP program, the Corporate Sector Purchase Program. It was a program that was announced by the ECB in 2016. And the issue that they were buying debt, this is quantitative easing, they were buying debt, bonds issued by non-financial corporations. And something very interesting happened there in Spain is that the firms started to issue bonds because the ECB was buying the bonds at a very good price. But the consequence is that there were many firms that prepaid all the bank's loans that they have, and instead of having bank loans, they issued bonds. And the reason is the one that you say, because with a bond, I can have a maturity of 10 years, and with the loans, the maturity is 1. This is very important. And I mean, the advantage of the collateral is that probably thanks to the collateral, you can extend the maturity of the loans. Right? Because they trust you, and then you can extend the maturity, but the cost is that you need to post for it. This is what we have said before, this is what we have said before. And the use of personal guarantees to improve regulatory capital. I told you that there are two things, two issues here. One is, I want to mitigate credit risk in that moment of the crisis, the sovereign debt crisis. And the second is, I want to improve the regulatory capital. How can you check this? To run this regression, what I can do is, the point is this, no? Both guarantees can be used to reduce credit risk. This would be the hypothesis, right? But after the shock, after the regulatory shock, after October 2011, personal guarantees were preferred. How can I do it? I have here the same regression where the dependent variable is the use of collateral, the two types, the guarantee, the dependent variable. And here the variable of interest is the policy change. And what we want to see here is after the policy change, after the October 2011, when banks need to improve their capital by 1 percentage point, what happened with the use of collateral. And everything is the same, right? Everything is the same as in the previous regression, but the interest here is that the policy change is a dummy that is equal to 1 after October 2020. Okay, what do you expect? If this shock affects the use of guarantees? Black. The use of the two types of guarantees increase a lot. You see the personal guarantees increase by 42%. It's huge. And the use of collateral also increased, but much less, right? So we have some tests here. We also use a period of 1 week because they tell you whether the shock was expected. So we were narrowing the window to use 1 week around the shock, and you can see what happened. So it's related to the shock. So it's not related only to firm characteristics, non-characteristics. After the shock, the firms pledge much more personal guarantees.
Okay. Sorry, what was the policy change again?
The policy change is that in July, it's in the slides. There was a stress test in July 2011, and after this stress test, some banks didn't pass the test. And what the authorities did is to have an agreement at the European Union level, such that after October 2011, the banks had to increase the capital buffers, but I think it was 1%. And the reason is that they were very exposed to sovereign bonds. It was the sovereign debt crisis, and in order to save the market, that we are imposed, but we have a lot of capital. So in case there are losses coming from the sovereign bonds, I can't repay. And then they require this. And the point is that how can you improve capital? I think that you're studying this. A way to improve capital is what? To decrease the risk weights of your assets. No? So the risk weight, for instance, of sovereign bonds is 0. So if you only have sovereign bonds, you will have a good capital ratio. If you have credit, for instance, credit granted to real estate developers, the risk weights are 150%, which is very large. So it means that when you add guarantees to this credit, the risk weight diminishes. Okay? You understand this, no? You have a loan has a given risk weight, but if the loan has a guarantee, the risk weight decreases. And this is what we did, what the banks did. So they use more. What is another way to convince you that this is the case? This is tricky because this was a single bank, the one that gave us the data. They didn't know that we were doing it, otherwise I think that they would never have gave the data to us. But given that it was a bank, what we did is to see the financial statements of the subsidiaries, because this bank had subsidiaries in several provinces of Spain. And what we did is to use the collateral of the subsidiaries. Which of the subsidiaries do you consider that could be more interested in using guarantees? The ones with the good capital ratio or the ones with the bad capital ratio?
With the lab, because we have to improve.
Exactly. And you can see in the first column that the effect of the policy change is there, so this is 47%. The banks that by default, this is the second row, no, have a capital ratio that is above the median. So sometimes, you have two choices when you run a regression. You can use the capital as a continuous variable, which is cleaner, but many times it doesn't work. Right? Here it didn't work. Because when you use the capital as the dependent variable and you use the continuous variable, it's more difficult because there could be non-linearities, no? So sometimes what is easier in order to use an explanatory variable is to use the dummy. It's below or above the median, right? Just to classify the banks into groups. Because it could be the case that the shape is like this. And probably you have a lot of weight here, you will take the part in which the trend is decreasing, right? Or it could be something like that, no? If you have a lot of weight here, you will find a negative. So that's why if you split, you don't care about whether it is 11 or 100. If the median is 10, it's fine with me. And then you split the sample into groups. Okay? And in that regression, you see that what is the interaction between the banks that have capital ratio above the median and the policy change.
You lower the personal guarantee asking.
Almost the same coefficient, right? Which means that the banks that have enough capital they don't need to charge more guarantees. Only the banks whose capital ratio was below the median, the ones for which this is 0, are the ones that are charging more guarantees. Okay? And by default, I don't care whether it was before or after the policy change. The banks that have capital ratio above the median require less collateral. Okay? We have a break right here. Okay, sorry. But is it clear? I mean, how to use the double interaction? Right? So you interpret the double interaction is remember this, is the differential effect. So if I want to see, and then we go for the break. If I want to see the total effect of the policy change for banks whose capital ratio is below the median, what is the coefficient? Below. We don't go to the break, we don't know this.
That plus that.
Exactly.
Above.
No, below.
Por eso, above plus median.
1 minus 0.
No. Oh,
And when you what was the question?
the question is, good point. No, the question is, what is the change in the use of personal guarantees after the policy change for banks whose capital ratio was below the median?
Only the middle one.
Exactly, the first one.
0.4.
0.472. Okay? Below the median. And what was the change in the use of personal guarantees for banks whose capital ratio was above the median after the policy change?
La beta 1 plus the other one.
Plus the beta 3. Okay? That is like a 0.07. Okay? And we are going to do this in a data, and you see that the linear combination doesn't give you a significant effect. So it means that only the banks whose capital was below the median were the ones that were charging more collateral, more personal guarantees. Okay? And this is what? This econometric difference is indifference. What is the treatment here? The policy changes the shock, and the treated banks are the ones that are above or below as a matter, but we split the two, okay? And the last one, and then I promise you. What is the coefficient total capital ratio above median? This minus 0.0069. What is that?
Dependent variable was
The first digit.
The dependent dummy was dummy.
It's the probability, like the change in the probability of asking for personal guarantees if you are out of the median after the policy change.
After, no, almost. Before.
Before, sorry.
Okay? So that coefficient, the second one, tells you the differences between the banks that are above and the ones that are below before the change, before the shock, before the policy change. And it tells you that before, the banks that were above the median, the ones with good capital, were requiring less guarantees. Fine, I mean, obvious, no? They have better capital, they don't need guarantees in order to lend. Right? Okay. Sorry. But I mean, this is important, because I mean, once you have this methodology well done, you can apply it. You get a shock, then you get the treated, then untreated, and then you have
Este es de kinder, bueno, y este es de locos.
So here, we are going to use firms that pledge guarantees. This is not a different if. It's kind of a different if because in the end the propensity score matching can be done for two purposes. One is to find samples that are comparable. So the propensity score matching can be used for two purposes. One is to define samples that are comparable. Yeah.
So the BSM is something we do previous to the analysis.
Yes.
We can use a BSM and then do a definitive, right?
Yes, as well. You can use the propensity score matching to compare, to find samples that are comparable. And after that, you can apply the differences in differences. Right? And the other thing is that you can use the propensity score matching to do a kind of matching analysis. And the matching analysis is the one that you do there. And I'm going to show you how to do it in this step. The matching analysis means that I'm going to do the diff and diff together with the selection of the sample.
How's that?
How's that? With a very basic command in which you select the sample and you assign firms that are comparable using you have to use this neighborhood technique, the Mahalanobis, you remember, no? And the Mahalanobis technique means that
It's a bandwidth, no? It's a bandwidth. A bandwidth.
the bandwidth is to define in some sense, the threshold or the interval that you want to use to compare firms that are similar or not. So the idea is that you have two firms, and with the Mahalanobis or several firms, they find the one that is more similar to the one that you like, and they assign to that firm another firm, or two or three, whatever you want to say. So it's very, very flexible. So here we are going to use this, the propensity score matching analysis, to do a matching analysis in which the treatment are firms that pledge guarantees by the first time.
So I understand what the diff and diff, because you explained it before. So when you add matching analysis, what is added? Like what is it added value?
With the standard difference in difference, you use what? You use always or panel regressions or whatever. And here you consider all the firms that are part of the different group, right? So the example is a treatment, no, a pill that is given to several people in the hospital, and the other are people that are comparable, so example they are similar and they don't receive the pill, and you compare it with a Oles regression. So here we have many firms. Some of them have guarantees and some others do not have guarantees. If the probability of having a guarantee depends on the firm characteristics, we have to be very careful on the firms that we are using to compare. Because on the one hand, you have some firms that obtain a guarantee, that have to pledge a guarantee, but the rest of the firms are very different. And then you need to find firms that are comparable in terms of the size, in terms of the maturity of the loan, blah, blah, blah. Because I have shown you in the previous regression that the use of guarantees is not random. So with the standard different analysis, with the OLS, it will be like a random analysis. You go to the hospital, you have 10 people there, and you give the pill to 5 and not to the other. And they are selected in some sense randomly, right? Here not, because you see that there is not a random selection. So depending on the maturity of the loan, it's more probable to have guarantees. Depending on whether the firm is large, it's more likely to have guarantees. And then we need to be very careful with this, no?
So the matching condense the sample.
Exactly. The matching finds for each firm with a guarantee a firm that is comparable to see what is happening with them in the future. So if I see a firm with a guarantee and the rest of the firms are worse, and I see what happens with the performance, it's not driven by guarantee, it's driven by the characteristics of the firms ex ante, because one is better than the others. That's the idea. Another thing very important when you use the matching technique and you want to use a treatment, and it's related to the FIRES paper that I presented in the the last session, a treatment is something that to do it perfectly occurs the first time, right? So there could be firms that have guarantees every year. They get a loan, they have a guarantee. Well, they have to pledge a guarantee. Is the effect in the firm behavior that we are going to see here associated to the last guarantee? No, I mean, probably this firm has been 10 years obtaining credit from a bank, and every year they have a guarantee, and the evolution or the behavior of the firm is not driven by the last guarantee, it's driven by the other 9 guarantees that have pushed these firms in some sense not to take risk. And that's the key point here. So we need to use the firms the first time that they have to pledge a guarantee, not prior guarantees of these firms. Because otherwise what we are estimating in some sense is not the effect related to this. In the example of the paper with fires, suppose that a firm has been affected by a fire 10 times. It's not that the bank now is not lending to the firm, it's that the bank knows that, look, I mean, someone is clearly the owner of this company, because every year we see a fire here, so I not give you money, I know that you are okay, but something special is happening here. So we focus on the first time that the firm obtains a guarantee. And the important here is that with the matching you have 2 groups, the treatment group and the control group. This is artificial, this is not an experiment. In an experiment, as the field is random. Here not. And then we need to do something that is, it's not going to be random, but it's comparable, it's very similar. And then the control group are firms that are, look, in the same industry. So I'm not going to compare firms that are in industries different to the ones that have to pledge guarantees. With similar size and profitability. If we want to study what's happening with the profitability in the future, we need to compare firms that start in the same point, no? And this is very important. When you run our version, these countries was, yeah, but probably there is a prior trend, and we need to compare 2 firms that start from the same point, no? And got the loan the same year. If you obtain the loan before you remember the period that we are using, no? It's not obtaining a loan the same in, let's say, 2008 or 2012. The loan characteristics were very different, no? Because the bank were taking more risk before the crisis than during the crisis. And that is, no? And then the dependent variable here is going to be an indicator of default. So the first thing that we want to test here, because we don't know it from the literature, is once a bank uses collateral or a personal guarantee for a firm, the probability of default of the firm increases or decreases.
Once a company uses collateral, the probability of default decreases, because they have some more to risk.
This is the theory.
But the opening is more expensive.
Exactly.
So you think that the effect is negative?
It's going to be positive, right?
No. I don't want to bias.
If you control for risk, exactly.
Or there could be no effect.
A 200 por measure.
It's negative
No, it has to be.
before 2010. So when the banks select the companies properly and they say, look, this firm could be risky, there is a problem of moral hazard or symmetric information, you have to pledge a guarantee, the effect is the one that we are seeing. I fully agree with you. You see, in the personal guarantee, the probability of default of the firm decreases. But what happens after 2011? There is no effect. Why is that?
Because you still have to have some guarantee.
Because they were using guarantees not for monitoring, not for avoiding moral hazards, not for disciplining firms. So they were requiring guarantees to everybody, right? So it's not positive. So the easiest thing for a bank is you come for a loan, you pledge a guarantee 200% of your wealth, no, of the size of the loan. Sorry, with your present and the future wealth. This is very safe. Banks, the only thing that they do is to require guarantees to firms. They are not doing it. Being lazy. They are lazy, exactly. But that's the point. Does it have an effect on firms? No, because the ones that are in the control group and the ones that are in the treatment group, I mean, the guarantee doesn't play a role. They are requiring the guarantees to everybody. So it's not that you are requiring guarantees to the people that are risky and the people that probably do not repay. So it's useless, right? Requiring guarantees to everybody. So it's better to monitor the loans than using guarantees for everybody. But important, this is very expensive because if we repeat the same exercise, right? But the dependent variable is the return on assets a year after the loan is granted, in the sense that in terms of my portfolio, it's not that I'm reducing the probability that the firms default for requiring guarantees. But what is the worst part of the story? What happens with profitability? It decreases. Because the firms are not going to take risk. So if you charge personal guarantees for all the loans that you grant, I mean, we need that the firms invest. Investing means risk-taking, right, in many cases. And the problem is that there is a negative effect that is the profitability of firms reduces. So the point is, yes, collateral is good. Up to now we know that risky firms, it means asymmetric information, whatever you want, but the risk of this strategy, and this is what I was saying, this is what I was saying here, I mean, it's good, it ensures good behavior, they don't default, but in many cases, the cost is very high because they harm firms and they don't invest. And this is what I wanted to say here. So this is the same that we had studied, but with other papers. So up to now, we were saying that guarantees are given by the firms in some sense. The safe ones say, look, I'm very safe, and to convince you that I'm very safe, I'm going to pledge a guarantee. And then the loan is granted to the firm. But that could be the case, right? If that would be the case, then what I expect is that the loans with collateral default less. And we have seen in the previous example that is not the case. There are no differences if you use a lot of collateral. But what happened in the regression, in the first regression? There were more guarantees when the loan was refinanced, when the leverage was large, and it's related to risk. So that's the point. The theory says this. The theory says that loans with collateral default less. But the literature says that, you can see here in this paper, usually the loans with guarantees are riskier and have higher default rates. Which means that guarantees are not offered by firms, but by the good firms in order to obtain credit, but means that banks are not so stupid and they are charging guarantees to the companies. And what this paper says, the paper by Berger and Noodle, so these are the two, let's say, parents of the empirical banking literature. So they are two guys that have been doing papers on banking from the 80s. Now it's not so fancy, but a few years ago, empirical banking was very fancy, but at that moment there were like 4 or 5 people doing empirical banking, and these are the ones that have been always there up to the death. In the case, they are very good. So what you see here is that the loans with collateral have higher interest rates, which means that they are risky. And what this paper says by book, also in the old literature, is that probably there is symmetric information. Probably the banks know who are the risky and the safe clients, and the banks are requiring guarantees to the risky clients, which is a different story. It doesn't mean that the other is wrong. It could be the case, but what the data says is the opposite.
And how can the policymakers, for example, incentive the banks to ask for less personal collateral without getting to over-risk, over-leverage their positions to the credits?
The paper I told you about Japan, I don't know if I have it here, I can send it to you. The paper I told you is exactly about this. The solution is a public bank in Japan offers the 2 types of contracts. And the firms themselves select the one category better. But the 2 types of loans is not with and without guarantees. It's with a lot of monitoring, and I'm going to ask you to give me a lot of information on you, and I'm going to be behind you. And you are going to pay higher interest rates or with personal guarantees. But it's something that has to be offered. So here we are not saying anything about supply and demand. it seems that the banks are supplying or the firms are demanding, right? And that's the difficulty.
So client segmentation.
Yeah, you offer the two contracts and the clients themselves segment into the ones that are willing to take risk.
And price them differently.
Exactly, but the ones that are willing to take risk don't take along with the personal guarantee.
Exactly.
They take along with monitoring. So I know that you are going to monitor me well, and I know that I need to pay a higher interest rate. I know it, but I go here because I want to take risk, right? And the interest rate is going to be much higher. So the banks are there to take risk.
So even okay, so I understand the whole point of borrowers don't ask for don't offer the collateral, and then it seems like banks are asking collateral if you are high risk or low risk. So the reasoning is less work, or what's
This is the other theory. The other theory is exactly this.
but that's what you just showed us, right?
Yeah.
Data.
I mean, there are like three stories. No, one is the firm offers the collateral because I want to show the bank that I'm safe. This is what we were saying before. The second is the bank has symmetric information, and I know that this guy is gonna be very risk, and I need that bit of discipline there. And then I charge collateral to risky firms. And the third, and is related to the previous point, the banks are risky. So in the sense that what is important here is there are two possibilities. One is monitoring, or the other is a guarantee. So what cannot be a possibility is none of the two, because none of the two means that I'm not monitoring. So the risk that the firm that don't repay the loan is very high, and the skin of the game of the firm is low.
You can have both.
I mean, both, yeah. There are some cases. I mean, this is the what I asked the authors of that paper to do in the next revision. That there are many cases in which you have both. I agree. And that was my comment. It says that you can have both cases. You can have monitoring plus guarantees, but not guarantees on 200% of the loan. I mean, it's a lower share. And I agree. I mean, the two could be the optimal, and that's what I was asking them. If they do it in the paper, I will send it to them. I'm not convinced that they do it. But the third story is the one that you were saying. The banks can be lazy. Because first of all, you need the screening and you need monitoring. And with a guarantee, you forget about the screening and monitoring. And the third theory, in some sense, by Padilla and Manaf, Padilla and Pagano, is exactly this. Banks are lazy. I don't need to screen, I don't need to monitor, and then I charge collateral and I forget about this. So if you don't work perfectly, then I get it. But again, I mean, this is bad for entrepreneurs, this is bad for investment, what we were saying before. No? And if that's the case, if banks are lazy and they charge guarantees, the conclusion is that if they don't screen, they could lend to bad firms. And this is something related to work in the financial crisis.
So it could be also because they could be interpreted as so like risk averse, like it's technically safer for the bank, and it's not like you're being lazy, you just don't want to take the risk. But with the collateral, you can claim your money anytime, right? Technically. So it might be only a matter of laziness. You mean, okay, I just don't want to take the risk, and I just ask for it if I can, right?
But suppose that banks are risk averse.
It may not be safer. They might, instead of, because they're becoming lazy, they don't really screen. Yeah, they just lend, and it will attract people who won't be able to fulfill their commitment. So they end up lending to more riskier individuals. Yeah.
That's true, but the point of being risk averse, if I'm risk averse, what I do is not to lend to companies. I buy sovereign bonds. That's that. I mean, you see the portfolio of the Spanish banks, so sovereign debt, Spanish sovereign debt, and it's huge. So I agree. I mean, banks are risk averse. If they are not, it doesn't make sense that they are not lending well. But this is my disclaimer. No? This is my opinion. And then you see the proportion of sovereign debt that they have in their portfolios, and it's huge. Of course, I mean, it's not that the sovereign debt offers a zero rate. They offer an interest rate.
But definitely a lower one.
But a lower one that than the one associated to this. But for instance, for the case of mortgages, you see that banks say that there is a lot of competition in mortgages, not here in Spain, in Europe. No? There is a lot of competition, blah, blah, blah. That's true. They offer very low interest rates for mortgages. I mean, you see the interest rates of the mortgages, part of it is because the collateral, I mean, a context in which the housing prices are increasing, the value of the collateral is going to increase. That's part of the story. But the second part of the story, and I would show it later, is that when you have a firm, probably with a collateral, at the same time you are offering the firm what? You are offering the firm many services that you have, and you are charging fees for what? For the pension plans, for the investment funds that I'm selling. You use my credit card, you know. So it's more than that. But the point is, this is the story, and the fourth theory in some sense is that the firms are very optimistic. They know that they are very risky. But look, I mean, do you want a collateral? This is very Spanish, ¿no? Lo de sujetarme el cubata, lo habéis oído. Yeah, collateral, and then they go there. So no, you can explain this version.
Like, oh my dear.
You are in the disco or wherever with the friends, no? It's like, no te atreves a and then sujetarme el cubata, no? Okay. So that's the same idea.
¿Qué pasa?
This is new expression, so at least probably don't know if I'm teaching this, but so and this is the same with the risky firms. No? I mean, the firms probably are risky and they, I mean, you want to charge collateral, that's fine, I mean, we pay, no problem. So these are the four theories behind this. Okay. So what happens is that ex ante and ex post, it mitigates asymmetric information and moral hazard, but as I was showing, the paper that they presented is not a panacea. So when you require collateral, firms don't take risk. Firms probably don't invest properly. So probably the firm is paying you the loan, but the firm is not able to obtain a new loan or to increase the size of the loan if they are not generating profits. Okay. Perfect. And then relationship lending. This is the last part of the class. What is relationship lending? It's what you can imagine. No? I mean, a firm goes to the bank. We have been talking about this for what type of information? For soft information. No? Soft information is obtained through relationship. So the firm goes to the bank. They ask for a loan. The more times they go, the better the information that they get. No? That's the idea. So there are two types of lending. The transactional lending that is based on hard information, and relationship lending is based on soft information. Okay? The two types of information, two types of lending. Transactional lending means that I just check the hard data and I tell you, and I tell you whether I accept the loan application or not. Soft information is based on other data, and relationship lending helps to take the decision. So relationship lending can be measured in three ways. One is the duration of the relationship. And the point here is that, I mean, I put you here this, but there are many papers showing this. I don't cite all of them because it doesn't make sense to give you names. Just papers, I want you to learn the theory. So the first is the duration of the relationship. The idea here is that the number of years that last between the first time that you come to the office and the current day. Right? So the first time that you came to my office to ask for a loan was 10 years ago, it means that I know you during 10 years. If it's more recent, it means that the duration of the relationship is low. Honestly, to me this is the worst, right? Because it doesn't mean anything, right? Suppose that you get a loan 10 years ago, there are many papers that measure the duration of the relationship, but this is 10 years. But if this is just once that you came to my office, it's true that you go to the data and you see that the maximum relationship is 10 years. Fine, but what is better? That person or another one that have, here I'm referring to the breadth in the sense that the range of products that have not the loan but a deposit, a credit card, right? And this is the other. So in some sense it's not the duration of the relationship, but is the number of services or the number of products that you have in the bank. With the loan, you know whether I'm able to repay or not. But if I have a bank account, if I have a, let's say, debit card, if I have a deposit, with that you can infer much more information than just from a loan. And the last one is the depth of the relationship. So if during 10 years you came to my office one, but there is another client that have a duration of a relationship of 1 year, but in the last year this client came 10 times, I will have much more information from the ones that came 10 times during the last year. Okay? So the point here is that larger, closer, and with more product means more relationship. Okay? And this is something that that is related to, as I was saying here. I mean, it's not just credit, it's credit lines, deposits, blah, blah, blah. So the bank can observe hard data from the relationships, but also soft information from the connections with the client. Okay, that's it. So what is the literature saying? Do you think that the relationship lending has a positive or a negative effect on credit, for instance?
Very, I don't know, because you have for, I don't know if increases or decreases it, but I know it makes the credit less defaultable, I think.
Okay, that's interesting. So the first thing is, the literature usually says that it has a positive relationship on the amount of credit. So this is the paper by Petersen and Ryan, which is one of the first papers analyzing relationship lending, and they find that firms that can be more constrained, so the younger and the smaller firms, thanks to relationship lending, they can show the banks whether they are good or not, and they mitigate credit constraints. So this is what the literature says, and I think that makes sense, no? Especially for firms that are more opaque. No? You remember the paper. Opaque firms, soft information matters more. Soft information can be obtained from relationship lending. Fine. The second one is about the cost of relationship lending. Here there is a paper by Berger and Udell that says that the longer the relationship, the cheaper is the credit, which also makes sense in the sense that, look, relationship lending leads to more credit, but at the same time, if I know the client well, I can price better the risk of the client. So, two clients with the same characteristics, suppose that the two are safe. If I know the client from a long time ago, the interest rate time to charge is low.
So basically beneficial on both parties, right? Because you get a cheaper loan and also save it for.
1 second. Yes, up to now. But so one question I mean is there is not much on this, no? In the sense that because you are referring to another dimension of relationship lending that is very important, that is soft information. So I can obtain soft information from relationship lending. This is what you are saying, and I don't care about the amount of credit that I obtain, or I don't care about the cost of credit. What matters is that thanks to soft information, thanks to relationship lending, banks are able to lend. And this is what we have seen in the paper with FIRES, no? That's it here. So there is not an increase in default, even lending to risky firms when they are paid because I know. Okay. So in this paper with Germán and Antonio that we did a long time ago, what we try to see is when does relationship lending start? And something unique about this paper is that the bank that gave us the data that they said gave us information on all the loans from 1975. What happens? There are many papers that study relationship lending with loans that were granted like very recently.
So I'm just really curious because you just said like if we knew you were going to use some papers, if I wouldn't have given you the information. So what do you tell them? Like, I'm going to use the data for.
No, for this paper.
Also, you actually told them.
Yeah. For the paper, I'm going to show. We told them that we were going to use the data for this paper, and they gave us the data to study this because it was a bank for which relationship lending was relevant.
And then you ended up using it for.
And then
A small bank. As working on a small.
No, I'm saying like
not so small. The issue is that if I say this in this course, but the issue is that something happened with the bank, and then we could use the data for the other paper because the bank was not there.
Oh.
Right? And then you see that the practices were not good. I mean, you require more guarantees, but at the same time requiring more it's not bad, right? This is what the realizes. I can read the lead. So I didn't say it in the last 10 hours, but no, yes, okay. No, it's not. So the advantage of this paper is that we can see the relationships from 1975
From?
until 2016.
Was it like the
Exactly. So there are not many papers having this long period. And then what we try to see this paper is when does relationship lending start to pay? Because I can see, I mean, it's not that papers use like 5 years of relationship. Fine. No, up to 40 years of relationship. And then you can see in some sense, when you use in econometrics the quadratic forms and so on to see the effect over time, whether to see whether it's linear or not. I mean, you need a long period. You cannot run this using 5 years, right? You need to know information from the past. And this is what we do. Okay, so we use here, you didn't mention this in the other classes, so there is an aspect that is very important in banking, the fees. Okay? So we wrote the paper using data from 1975 till 2014, sorry, it's 2016. But one referee said, yes, but what happens with the fees? And this is very important, because when we use interest rates, we usually don't see the fees. And the key is that you can play with the fees such that you can say, okay, the interest rate is low, yeah, but the fees are large, right? Because the fees are paid up, and this is tricky. And then they told us to repeat everything, and that's why you see here that we use from April 2013 to September 2014. But this is because we only have fees for this period of time. And in order to measure lending and the cost of lending properly, you need fees. The other papers that I was mentioning, they don't use fees. So you are showing me a partial view of the cost of the loan. You need the fees. And that's the point. I mean, this is the disclaimer, no? We use the fees and we need to reduce the fees. But doesn't matter, because in terms of relationship lending, I can measure relationship lending the same from 1975 for the terms that I have in the sample. Okay, so this is
There's no cap or law regulating how much fee you can charge a customer. Besides, like the states is outrageous sometimes. Like I got a loan for 300 million to get a loan, and the structuring fee was $1 million. So it was like how do you justify that?
No, I mean there is no. That's the point. There is a paper done with European data that is titled like Mind the Gap, refer to the fees. Because I mean, nobody was using the fees until that paper. And we were not very lucky because the paper was published when we were working on this. So probably the referee was the author of the other paper, and they told us you need to use fees. Fine. And then that's the point. So I don't want to spend more time on the descriptive statistics, but you can see here, for instance, the loan rate with fees, no? Is 5%, the average. Probably if you remove the fees is 4. Okay, so it's much less. And this is all the characteristics. So the important thing is that in this paper we measure relationship lending with four variables. That to me these are. The other contribution is this was the only paper that, even that we have information, not just on loans, but on many other types of contracts, we can measure relationship lending based on the duration, the couple months of the duration. That is the simple way, the standard. The second is the proportion of loans that are amortized relative to the firm debt, and this is like a capacity of the firms to repay the debt based on previous history, right? So suppose that the loans that have been amortized during the long life of the firm, from the 70s. Okay, so there are many cases in which you see the loans amortized here is, the average is 2.53, right? And you see that the maximum is 49, because we are accumulating loans during 40 years. And we are comparing the loans that have been amortized, so effectively repaid, over the firm debt today. Okay, this is like the intensity, the breadth. I was mentioning the duration. This would be the breadth, which means that, look, if I have repaid 40 times my debt now, you can imagine how many times I have gone to the office to talk to the bank office. The third one is the cross product. You remember this is the second one is the debt that I was saying in the slide. The third one is the breadth, in the sense that there is another product associated to the firm and the bank. Suppose that the firm has a leasing or a credit card or a deposit or whatever, and then if it's one, it means that they have other. So if in 13% of the cases, the firm has another type of liability with the bank, not just the loan. So if we focus on loans, we are seeing a partial picture of the relationship. And the last one is the exclusivity. Right? This is a new measure. So I told you at the beginning, the first one is the duration, the one dealing with the amortized is the debt. The third one is the breadth, in the sense that there are more products. And the fourth one is another very important measure of relations lending, that is the exclusivity, which means that how important is the bank for the firm. So of the total credit that the firm has, which is the credit granted by this bank. On average is 10%.
It's credit,
Credit.
nothing to do with equity, just credit.
Credit.
So, I'm curious. You said the data was given by a bank, obviously you have to compare your client. So how do you know how exclusive you are with, like, you check on, I don't know, the system, if it has existing loans with other banks?
No, because from the balance sheets statements, you can see the total amount of bank debt that they have. Right? So
Yeah.
if you go to the financial statements, you can see the total amount of bank debt. I mean, you are right in the sense that the financial statement is, let's say, for 2014. And it's true that I'm, let's say, using this information as of December 2013, let's say, and the numerator in some sense is the exclusivity in different months. So it's not perfect, you're right, in the sense that it could be, suppose that the firms have a huge amount of loans in a given month and it does not appear in the balance sheets, then I'm not capturing this. But you can see that is between, let's say, 0, in the sense that it was the first time that the firm obtains a credit from that bank, to 94%, which means that all the credit of that firm comes from this bank. And this is why this is not 100, because it's a point of time in which the credit has been evolved. So I don't see the total amount of credit. So I cannot have 100, and you're right, in the sense that it's not. So the dependent variable is the loan spread. So when you have data on interest rates, and if you want to use a regression, the dependent variable is the interest rate, don't use the interest rate itself, especially if the period is long. Why? You told me this before. The interest rate depends on what? On the risk-free rate?
On the premiums, the third premium, the liquidity premium.
So the clean way to deal with this is to take the difference between the interest rate minus the risk-free rate. In that case, is the Euribor amount. So if you have a very long period in your regression and you use directly the interest rate, and in your regression you have some macro variables or some variables related to the bank that evolves jointly with the evolution of the market rate, the coefficient that you are going to get probably is not revealing the, let's say, the extra premium that the banks charge, but the evolution of other variables, the trend. Suppose that this period is very short, but suppose that they have a very long period. And I mean, the interest rate depends on what? The central bank sets interest rates based on inflation, based on output, and then you can say, look, I mean, the coefficient that I obtain for the GDP is positive, fine, but it's not because of that, it's because, I mean, you know?
Yeah, that's the spread.
Exactly, so you need to use the spread, okay? Fine.
Never regress the interest rate in what, so depending variable was wrong.
I mean, it's not that it's wrong. I mean, it depends on what you want to measure or on the controls that you have. I mean, you can suppose that I have time fixed effects, I'm fine,
Okay.
right? Because the time fixed effects I'm not going to capture this, right? But if I cannot use time fixed effects, people can tell me, yeah, you need to see this.
And fixed effects can be a trend I add to the regression.
Exactly. Time fixed effects will capture in some sense the common component in the interest rate in each month. But if you use, suppose that here I use month fixed effects, people can tell me that within a given month, the interest rate will change, and I'm not capturing this changing with the, you know. I mean, there is always an excuse to say that what you are doing is wrong. No? This is here. So the point is, if you use day fixed effects, fine, but then, I mean, how many fixed effects do you have here? Okay, so it's better to use the spread relative to the market and you forget it. And then we use all the relationship lending variables, right? Which are the duration, and given that the duration is very long, we also use the square. In order to see whether the duration has always a positive effect or is not, or is concave or convex. Okay? Duration, the amortization, the cost product, and the exclusivity. And the hypothesis, the first hypothesis is that relationship lending, I mean, depending on the dimension that we are using, here you have 4, reduces the loan interest. And the point is what you were saying before. I mean, soft information matters, what we are seeing in the slides. On the paper by Berger. Soft information matters. I know the firm better. The larger or the longer or the stronger the relationship lending, the lower are the interest rates. This is the first hypothesis. Okay. So I mean, it's better if you write the hypothesis. That's why in the homework I asked you to write the hypothesis. The second is that the connection is not linear. In the sense that the duration of the relationship lending is not linear. So this is the whole problem that they were saying, in the sense that at the beginning probably you benefit from a lower interest rate, but when you become a captive client for the bank, they charge higher interest rates, and this is what people have said. But what we find in the paper is that given that we have a long relationship, there is a point up to which the bank knows you quite well, and then they start increasing the interest rates. So it's not linear, it's concave, right? So first of all, I attract my clients. I offer low interest rates. Then I need to extract the rents from this relationship, and I start charging higher interest rates. And there is a point after which I know you quite well, and I know that I can trust you, and then I start increasing interest rates. Okay? And then here, what I want to say related to the content is that this is driven by soft information. And again, if I want to check whether it's driven by soft information, which are the firms that I consider? There's more ones. There's more one, there's more way. Okay? That's the thing. And let me show you the reasons. So first, negative relationship with the duration, fine. What we expect. The longer the duration, the lower interest rates, fine. The amortization variable, the second column, tells you that the more loans you have amortized relative to your size today, the lower is the interest rate. So you have shown me that during many years you have been repaying the loans to me. I believe you, I trust you. The second is the third is the cross product. This is not significant. I don't know why, but this is among all the dimensions that we are using. This is not the most significant. I didn't have information on deposits, or I didn't have information on the bank accounts to see. But I mean, in terms of leasing, other type of liability, this is not significant. And the fourth, the exclusivity is also significant. So if you are my main client, I'm going to offer you lower interest rates. That is related to some of the comments that you were raising in the past. And when we put the four of them together, you see the same results. There is collinearity, right? I mean, all the dimensions related to relationship lending are correlated. That's why you see the first column, which is the coefficient, 0.03, and which is the coefficient when we use the four together, is half. This is because there is correlation, right? So it's not that they are independent, of course. I mean, if the duration of the relationship is longer, it means that you have come to my office more frequently and you have repaid the loans. And that's why you see the second one, the amortization, you see the coefficient goes from 0.06 to 0.03. The correlation with the others, you see the column 3 and the column 4 is not so large. And you see that the coefficient for the third and the fourth in the last column is more similar. It's not so different, right? So it is not always perfect, but when you combine or when you put many variables in the same column together and you see that the coefficients change so much, it means that there could be autocorrelation. It doesn't mean that it's wrong. It means that if I use the duration variable just itself, it's going to give me the effect associated to the duration, but also part of the effect associated to the amortization Okay, so when you see that the coefficients change so much, be careful. You need to repeat the regression and to see the correlation with the data because something is happening. Okay. If the coefficient jumps when you include another variable, it's not that it's wrong, but you have to be strategic. Don't report the two individuals, just the two together. Okay, and then nobody can see that. Because sometimes it happens. Okay. So again, I mean, it doesn't mean that it's wrong. No, it means that you are accounting for. There is an omitted variable that when you include in the regression, you get the real effect, not the one that was associated to the. And important, the guarantee. Look, this is positive and significant. Wow. No? What the first paper was saying is that loans with guarantees have lower rates. Why is this? It's related to the previous paper because the two come from the same data. It's saying what? That the banks are using guarantees for what? For hedging risk. So they are charging guarantees to who? To firms that are risky. It's true that when you compare, and this is very key, yeah? I mean, you cannot say, look, the larger the more likely the use of the guarantee, the larger are the interest rates. No. It's because we are comparing firms that are different. So if you want to check the effect of the guarantee, you need to restrict the sample or to use fixed effects to compare firms that have exactly the same risk. And then you will see that the use of the guarantee means lower interest rates. But here is a pool. And what you observe for the case of the guarantees is an endogenous effect of the risk. Riskier firms have guarantees, and riskier firms have higher interest rates, even with guarantees. Right? The next result, the duration. We are on time. The duration is what? This is concave or convex?
It's like you or no.
That's the question.
If the square root duration is negative, that's not a hump. It's like this or no. It has a minimum.
It's concave, no?
It's concave if it's minimum.
Exactly. The first is positive, so it increases, but the other is there is a maximum. Okay? When it's negative, the second derivative is negative, there is a maximum. And the point is what? This is concave, no? And if you want to see what is the maximum, you take the derivative and you multiply, you equal it to 0, and then you see that the maximum is after 25 months. Right? Which means that they offer a low interest rate. It starts increasing. Up to 2 years, they find the maximum, and after then, it's when it starts decreasing. Okay? So it's concave. And to show the hypothesis, I don't show you here the table. We restrict the sample to firms that are opaque versus the ones that are not opaque, and we find that this occurs especially in the firms that are opaque. So the effect of relationship lending on interest rates for the firms that are very large is not significant. Because relationship lending always matters when there is growth for soft information, when the firms are opaque. When they are very large, very transparent, the effects don't occur. Okay? So only when they are opaque. And here I have and this is not very clear, but the referee asked for it, and we have to do it. You see, first you see a decrease in interest rates, and you see, for instance, this is like the Turkmen effect, like the previous methodology. This is the average interest rate for firms depending on the relationship, you know? And then you see that it starts in a discount of 0.083. The maximum is at, after 6 months, because it's almost 0. You see like the minimum, then you see that it starts increasing at the point of 25 months is 0, which means that it's increasing until then, and from 25 months, 36 is flat, and then it decreases again. So this is like the concave, right? But with numbers. And this is the discount that they are offering. So at the beginning, I offered you lower interest rates during how long? Well, up to, let's say, 24 months. After then, I don't offer you a discount, and then it decreases again. Okay? And that's all. So the point is this, no? That relationship lending starts to pay when? After 2 years. So I take you, and once you are with me, you are my client, I start extracting rents. and after 2 years, I offer you this maximum. And this is the hold up problem that I was saying, because the banks in some sense take the firms with itself because it's very costly to change the bank. There are switching costs. And given that there are switching costs, firms continue with that bank. And the bank continues structuring this. So I think that 7 minutes.
No, I know.
2 breaks.
Yeah, I know.
We are almost done, eh? We are almost done.
That's great.
No, we are almost done. This one is the no. Why is relationship learning important? On the one hand, you could have negative effect, no? In the sense that I think that I know the firm quite well, so I am overly sympathetic, as I was saying here, lending to a firm. So this is a problem. And relationship learning is important, but there could be a risk of complacency. In the sense that I know you quite well, that they give you money and I don't check your accounts. You remember the case of the user card, you know? What you said before, very important, the multiple versus single relationship. Okay, so then, what is the optimal for the firm? Working with a bank or working with multiple banks? And this is key, no? On the one hand, working with one bank means that the bank is going to know me quite well. So relationship lending, if I'm opaque, is even more important. If I work with a single bank and there is a crisis, as the one that we were saying before, suppose that the bank was not Bankia, with Bankia. Bankia defaults, then for me it's very costly to change the bank. Not just the bank, suppose that Bankia, because Bankia closed many branches, many offices. And then I need to go to a new office, right? So there is always an equilibrium. Pros and cons related to both. One bank, more intensity of relationship lending, as I was saying before, especially the exclusivity and the ability to amortize debt. The negative side is that if there is a crisis, then I have a problem. And well, I mean, this is the single lender, what I was saying. This is the big elements. And this is the last part of the class. One important thing, during a crisis, the relationship lending is especially important. And there are some papers. There is one slide, look at the slide, sorry. It comes later, okay, I will go to that one. Empirical evidence. So the two papers, the one by Petersen and Ryan, the seminal paper on relationship lending, more relationship lending, more credit. The second one, more relationship lending, cheaper. This one, the paper by De Grijs and the other that I don't know how to pronounce, found that there is a hold-up problem that I was seeing. So at the beginning, they offer lower interest rates, they start increasing the interest rates, and they stop there. What we found in the paper is that, yeah, there is a hold-up problem, but this hold-up problem is mitigated when the duration of the relationship continues. Okay, so it's not that is positive. Is that if I use the quadratic form, the concave form, you see that it's there. Okay, so it's very important when you see an effect, you see it's positive. I mean, take into account in some cases the quadratic form when you wanna study an effect, because probably there is a maximum or a minimum, and then you need to consider this in the data. Because suppose that the coefficient that you estimate is like this, and then you depict the coefficient and it's like that, and then you say, okay, so there is a concave form. But when you see the data, all the data are in this part of the. There is a concave form, but all the data is in the quadrant. You have to be careful with this. Something different is that if you find this, many data are here, like is the case, then you have to be careful. Okay, so you always see what is the maximum. In this case, it was 25 months. I know. And then I see that there is a positive and negative effect, and that there is enough mass in the distribution of data to decide to talk about the concave form. Otherwise, if all the data is here, I cannot say it. Okay, I can say that is positive, but with decreasing slope or decreasing marginal effects. Okay, that's it. So competition, what you said before, here it comes. This paper said that if there is no competition, right? So in case of monopoly, that we're talking about this, banks are not willing to finance the firms in which soft information matters, because they know that they can build a relationship. So a young firm that I don't know, the firm comes to my office, but if the market is very competitive, tomorrow they can go to a different bank. If I know that there is a monopoly and the firm is going to come to me, then I prefer to treat the firm better because it's a firm with potential, and then with the relationship lending I can infer many things about the firm. Right? So relationship lending depends on not only the duration but also on whether the market is competitive or the market is not competitive. Here, no, what we said before, the structure of the banks. When the banks are local or are very small, relationship lending is better. The example of the FIs. When the banks are very large, remember the case of the distance, no? The relationship lending, the soft information, loses its value as the distance increases. So when the banks are very large, relationship lending matters less. And this is the summary, and that is. So the other important thing, during crisis, there is a paper that shows that relationship lending is especially important during crisis. And remember the paper of Silver Bank debt that I explained at the beginning, no? It was a huge crisis, temporary crisis, and you see that only firms with the relationship with the banks were able to obtain it. Those with the relationship didn't. So this is another thing to consider how important it is for firms to have a bank, because in case of a crisis, the banks are going to help the clients, the ones that they deal with. Okay? We are done. Let me see. 1 minute. So tomorrow I will prepare some codes with data. I give you examples. I debate with the monetary policy part, and we can talk later. Okay, if you want to know something else for monetary policy, transmission, or whatever, we can.
If you have a book, we can recommend it.
The book for relationship lending or yeah, I can recommend you a book or we wrote a chapter in España like 3 years ago. It's very well explained. 30 pages.
你明天上午不是有那个会吗？那明天下午弄这个事儿不？
我看今晚我有没有时间，我将有没有文字稿，然后也是明天就是抽时间搞，我周末之内肯定把它搞好。
那不是，我今天晚上得准备他的课，因为明天是最后一节课了。
他的课
啊，
要准备什么？
不准备什么，就是学一下，因为明天最后一节课了。
要考试吗？
不考试，就是说那个你不用准备，就是我想找他要推荐信回来。
哦，你要找
他是央行的，就是西班牙中央银行的。
哇塞，推荐去工作吗？出国。
不知道有没有用，但是这个还是有点用的。
那你要怎么为什么要准备什么？
啊？
要准备什么？
就是把他所有的课、所有的细节都过一遍，然后明天显得对他最近发的论文都懂，让他觉得我这个学生啊，就是说能知道他怎么回事。然后比如说去问老师，就是最近在干什么，需不需要那个帮忙一块弄这个那个文献啊什么之类，可以给他打下手，然后就可以要推荐信。
哦，哇塞！
那只有这样。
我就不搞，没时间。那你到时候告诉我你什么结果，看他好要不，看他好要不，看他要不要让你帮他写文件。
因为这个感觉找工作有原因，因为他是在西班牙那个银行，就是央行工作的。
你说找工作也有用？
我不知道。具体的东西咱也不知道。
那好吧。
因为那个光头不是答应给每个人都写推荐信吗？
真的？
不是吗？
不知道啊，什么时候？他那么牛的人，能给我们写推荐信啊？
写推荐信肯定是会写推荐信，但是你读博的话，就写推荐分两种，一个是强推，一个是普通推。强推就是跟你说这个学生很牛逼，普通推就是说一堆废话，就这个其实普通推没什么意思。你说这个学生很勤奋，然后上课很用心，然后会考试，会说话，会吃饭。然后强推就是说这个学生是我带过的最好的，这个人以后一定是牛逼人，你们赶紧录取他吧。就是强推的话，一个强推可能顶好几个普通老师的推荐信。他不知道，但毕竟是客座教授，就是他不是我们学校老师。
你试试吧，要告诉我结果怎么样？
不好说。
我说给了你，
没事儿，最坏的结果他记住我这个人，然后能多给点分儿。
也不错。
嗯。这中学期的课基本上上了一半多了，就剩2门课了，一个金融学2，一个金融学3。
可以。
这3门课都结了，一个是那个老登的，然后一个是他的，一个是光头的，都结束了，然后再加上那个计量结束，基本上下个月就开始考试了。
Claro, tuvieron que replicarlo, subirlo ahí.
Sí, sí.
¿Los datos los pusieron o no?
Sí, sí, hay una page online y aparte tiene un notification que es un zip con todos los
Pero los datos están, ¿no?
los datos de
Del